Alona, help me better understand how post GFC and a new and more restrictive regulatory environment gave rise to, and I know you are not a big fan of this, but I'm going to use it anyway, shadow banking system, not derogatorily, just not the real true banking system, and how private credit is one of its expressions. Do you want to share a little bit about that, and so we can get the framework?
Sure, happy to. And thank you so much for having me on this podcast. You approached me about it, and I felt so flattered. And to be, in your words, a private credit expert, I will do my very best and just share perspectives from what I've seen so far. But as far as the shadow banking term that you use, yes, it's one that I want to spend a little time clarifying, because I do feel like it can tend to be used in different ways and sometimes just have a sort of negative connotation to it. But just broadly speaking, if we start there, the term has come to refer to a broader base of the non-bank financial companies, right? And by their nature, operate with less oversight from regulators than traditional banking institutions. But that said, there is still a very great deal of rigorous credit underwriting, portfolio analysis, risk management across the non-bank lending universe that, is really important to these platforms, particularly given the rise of really large non-bank lending platforms that are actually supported by massive asset management businesses, global financial institutions, really big insurance companies that they themselves are regulated. So certainly, while non-bank platforms have less oversight from a traditional sense, I just wanted to say it doesn't necessarily mean less oversight overall, right? And arguably, as we'll get into later, potentially as the supporters of private credit, non-bank lenders could be seen as potentially more appropriate long-term capital sources versus banks that have more of that customer deposit sort of capital base. And that non-bank platforms have diverse capital sources, so better able to withstand cycles. But let's go to your original question about sort of how did this whole thing get started, right?
Right.
So as the rise of non-bank lending, when we go back to sort of that GFC era that you were talking about earlier, I'd say you're absolutely right. The growth of private credit was really born out of all of that legislation that you talked about that was really passed in response to the great financial crisis in '07 and '08. And then the 2010 Wall Street Reform and Consumer Protection Act, both together known as the Dodd-Frank. And then afterwards, I think you mentioned this as well, this edition of the Volcker Rule.
Right.
And if you even fast forward 5 years, in 2013, we got the OCC, the Office Controller of Currency, to come in with leverage lending guidance, as you mentioned earlier, just sort of curtailing the amount of leverage that institutions could put out. So it made it essentially really punitive for traditional banks to extend credit, right? So traditional banks overall found themselves in a situation where there was much closer, regulatory scrutiny, and essentially, created this sort of retrenchment of capital, if you will. And that capital being available to borrowers, particularly those considered smaller than the large corporate, and what's now known as, more broadly, the middle market. And to many investors' surprise, this middle market segment has actually shown some pretty impressive resilience and growth. So while you saw this capital retrenchment happening from traditional lending sources, at the same time, you'll remember that the Fed embarked on a massive stimulus campaign to really get the economy back on its feet. And I think in less than a year, we saw the Fed raise, cut rates by almost 300 basis points from 4.75 to 2, and then got us to 0 by the end of 2008 and sort of stayed in that very low range for quite some time. So you've got this combination of capital retrenchment and then very low rates. I'd say what happened at the same time there, asset managers, insurance companies, institutional investors were all in this search for yield, right? And it fueled this growth into private credit investments, right? And that gave rise to this new class of non-bank lending platforms, which really were really in place to support, post-GFC, strong, healthy businesses that just tend to operate in this middle market that still had growth capital needs. So effectively, I'd say it was regulation, tighter regulation, and then that combo of a search for yield that helped fuel the growth of non-bank lending platforms.
You're giving me a lot, so I keep thinking all these more questions, so I'm going to try to remember all the questions I have in my mind.